And we are jumping once again to record highs in U.S. stocks. This is certainly a very interesting situation in markets here today. Without a tremendous amount of news, we continue to power higher, but perhaps it is because we have the one day this week that there is a bit of a lull in key macro data. Well, we're going to look at all the rest over the week and whether this enthusiasm can continue. This is Macro Money, of course. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to look ahead to every other day this week where there will be an absolutely blistering schedule of all kinds of economic data that's relevant for what's going on in the markets here. But we'll hit the big key points here, starting in Europe and then shifting over into the US. It won't be in order because, of course, these things are interspersed one after another. But we'll have a conversation about the Euro area and the UK first, and then focus on what may well be the more potent, more influential set of releases out of the U.S., which should have knock-on effects for all of the markets across geographies as the second order of business. So let's begin here with a conversation about what's coming out from the Euro area, because here there's a really interesting set of numbers, and it comes at a very interesting and auspicious time for the Euro. First, we're going to get an initial look at fourth quarter GDP numbers. Expectation is that we're going to return to economic growth. We had a flat quarter in the third quarter here, through the 3 months through September, giving us an economy that did nothing, zero, no growth, no contraction. In the fourth quarter, the expectation is we're going to see a little bit of activity return, 0.1% expansion on the menu here. The worrying bit, of course, is that Germany, which also reports its GDP numbers on the same day, is set to report the second consecutive quarter of contraction, down 0.4% in the third quarter, and the same is being expected for the fourth. And that's the Euro area's largest market. So not great. The increase here expected to come mainly from the pickup in activity elsewhere in the Euro area, with France being a standout. Later in the week, on Thursday, we're going to get Eurozone CPI data. No big controversial release here either, down from 2.9 to 2.8% on the headline figure. We explored this in detail last week as we were discussing the ECB, and we saw that, of course, inflation continues to be mainly powered by food costs. That's that shiny purple area or violet area at the bottom of the screen there. And of course, we can see that it's been moving lower already. Now, when we consider that there seems to be about a 7-month lag between where global food prices go and their reflection in CPI, we also find that there seems to be more of a ramp for them to continue to decline. The latest numbers on global food prices continue to point to perhaps about 3-4 more months of a down ramp. So as we look at this, then we get the sense that the ECB at least has the ingredients it needs for things to be moving in the right direction. Now, if we look at the way that Eurozone economic data has been performing relative to forecasts, we find that while there's been a little bit of an improvement, we're still, number one, below zero on the City Economic Surprise Index. That means that the data still continues to broadly tilt toward underperformance, but perhaps modestly so. mostly because growth expectations have been lowered since about mid-year last year. If we look at what the consensus there is. And of course, with that, we have also seen essentially the bar lowered for the data to beat. So there's been some understandable adjustment there. But if anything, we're looking at numbers that are very close to expectations, given this convergence between outcomes and forecasts, with a slight risk on the downside, a slight risk of disappointment, which comes at a very interesting time because, of course, the euro is attempting to break down what is a 4-month up move. It's trying to squeeze through support here and cement what is a trend reversal in the US dollar's favor. That comes after the ECB monetary policy announcement last week was interpreted to basically set the stage for a more dovish perspective, for the start of rate cuts, which at this point are expected to begin no later than April. In fact, the markets are flirting with the idea that it may come even sooner, and the expectation now seems to be that we are going to have 5 cuts on the menu for this coming year. So the markets are baking in 130 basis points. That's 125 basis points in cuts already there. So 5 at 25 basis points, or a quarter percentage point apiece. And then the slight possibility for a 6th, though that possibility is at this point just coloring the slightly dovish bias on the 5 cuts. It's a very modest overshoot. So the euro ostensibly then is looking at economic data that might well support this idea and give us some scope to continue to extend lower if this data registers even in line with forecasts. And then, of course, if it surprises a bit lower, all the more reason why the euro might feel a pull southward. Then we're going to get a monetary policy announcement from the Bank of England. And here we're not looking for any policy changes, but the direction of travel of expectations for when their rate cut cycle is going to kick off. That has been somewhat in flux and moving in a more dovish direction, even beyond the December policy meeting. Most major central banks had their big dovish adjustment from November onward, and that really followed the Fed setting that tone with its meeting on November the 1st. We can see that in the case of the UK, there's been a little bit more of a dovish slide, ever so slightly, from the December meeting now and up to now. So that the December meeting is the small dashes there. The current setting is the solid line, and we can see that we're currently at 5.25, and we get to essentially at least 1 cut within 6 months' time. So we're talking mid-year for the start of a cutting cycle, and 1 year out, it looks like we are down just about 1.25%. That generally lines up to about 1% for the calendar year 2024. Of course, there's an implicit expectation there that January of next year will be, or February of next year, rather, will be a BOE cut. So with that in mind, we look at UK economic data that has actually started to go the other way. There's been a fairly significant improvement in UK economic conditions over the past 3 months. We've seen the economy return to growth. We've seen the service sector rebound. There's pointedly a contrast here with the euro area, where the economy continues to shrink. The only reason it's shrinking at a slightly more modest speed at this point is that in the Eurozone's case, manufacturing has started to stabilize a bit, still shrinking, but at a bit of a lower rate, with services basically idling. The UK has now returned to growth that is starting to look like some of the fastest performance we've seen in almost a year. So the story from the Bank of England here might well be going in the opposite direction from that of the ECB. They may, in fact, push back. In fact, the market's priced in inflation expectations in the UK have started to creep up a little bit. So that seems to suggest that we're looking at a situation where, while the data out of the continental part of Europe encourages a dovish ECB view, the Bank of England, in its assessment of the data, might actually go and see something else entirely. This is a very interesting situation, of course, for the pound, which already is doing better than the euro. The euro is going down. The pound is locked in a fairly well-defined range here. We could try to make a break for this resistance at the range top just over the 128 figure against the US dollar on the 6B contract. So that'll be something interesting to watch. We can see support here just above 126. We're right in the middle of the range now, and we'll, of course, see what the Fed does to this, which will arrive before the Bank of England. But the key thing to watch for here will be whether any sort of hawkish squawking from the Bank of England has the potential to clear that range top away and set the stage for what could be the next big run, which might even put 130 or 131 in view, with a return to mid-year highs, mid-year last year. And that, of course, shifts our conversation to the Fed, because this really will set up to be the most influential release, in my mind, this week, and really establish where we are in a big way for financial markets. Now, the general trajectory for the market's relationship with Fed monetary policy has given us a very clear story up until perhaps the beginning of this calendar year, where things are beginning to evolve a bit differently. And this week will be a critical test of what this looks like. So note here that just looking at the second half of last year, there is a clear inverse relationship between how many rate cuts the markets expect to see and how good stocks feel about it. In the gray bars, what you have is the rate cut outlook for 2024. That's the spread between January and December Fed funds futures implied rates, which essentially just give you how many rate cuts you're looking at this year as far as the markets are baking in. You can see that from mid-year through about October, the number of cuts is diminishing. So you go from down 1.5% or so to down 1 or 75 basis points. In that time, you can see that stocks decline. There is, of course, a transition. So from about June to August, rate cuts are able to come in and stocks are going higher, because ostensibly what's going on here is relief, because all those cuts were in the outlook, contingent on the need for some kind of firefighting following the SVB banking crisis and all the other tech-oriented regional banks like Signature and First Republic that succumbed in that episode, and of course the hurried marriage of UBS and Credit Suisse against the same backdrop. The easing of those concerns clearly had stocks moving higher, allowed them to move higher. And then we got to a breaking point. Then we got to too few cuts for the market's comfort, and stocks started to fall. So we can see that right here. The cuts are okay, the cuts are okay. And then we get to about here. And more cuts stop being okay. Now the market feels like borrowing costs are going to be too high for comfort, and stocks come down. Well, where are we now? In the same spot. Right here is about where we sit currently, having seen a peak of 6 cuts as this cutting cycle expectation started to rebuild. We saw the rebuild occurring from late October, early November, and of course, stocks roared higher at the same time and cheered it. Now, we've arrived at the beginning of this year with a sense that maybe 6 is too many. And what we've started to see is some of those rate cuts started to come off the board. We're now down to 5. And as I say, we happen to be pretty much exactly where this relationship was on the move last time. And so far, not only have stocks been okay with rate cuts going away, they've actually moved to record highs, as we mentioned at the top of the show. The key question from here, then, is could we shave off more and still maintain this resilience? At the same time, the US dollar has managed fairly strong performance as those rate cuts have diminished. This, of course, speaks directly to the dollar's yield appeal. Fewer cuts means its rate attraction compared to other currencies is greater. Of course, the euro has been a key foil for this story, whereas the markets have become more dovish on the ECB, they've become less dovish on the Fed. And so the dollar has moved higher as we've seen fewer rate cuts in the outlook. How this evolves from here will very much depend on what the Fed says. The Fed said in December, when it last updated its baseline economic projections, that it is looking for 3 cuts. The markets have 5. The U.S. economic data story has looked better. And we can see that in the U.S.'s version of the Economic Surprise Index, which has now broken above its 20-day moving average, which approximates the monthly trend, and seems to be pushing higher in a spirited fashion. Last week's GDP numbers, of course, are a part of that story, as are the very strong PMI numbers that we got last week. So all of this seemingly line up to give us a better view of the U.S. business cycle. Now, the Fed has been a broken record on its insistence on data dependency. So it seems very difficult for them not to name check this data in the announcement this week, and then for the markets to consider, well, maybe this means even fewer cuts. Maybe the Fed was right to think 3. Perhaps we can down it to 4 for now and see how the data evolves from 5. Now, again, we seem to be at this inflection point here where for stock markets, the dividing line between an acceptable amount of cuts and a worryingly low one appears to be right about here. And so it'll be interesting to see what it is that stocks make of a Fed that at least nominally acknowledges that the economy has been doing better and perhaps hint that what this implies is a slower path to easing. Now, given the Fed's penchant for vagaries, the first test of whatever it is they say will then come Friday, because we clearly don't have enough event risk as it is, because the U.S. will release the very closely watched official employment report. Now, we're not looking for any controversy here. 180,000 jobs added. That's a little bit cooler than the 216 from the prior month, but very much within the recent range. Jobless rate seen going up again a hair toward the top of its recent range, 3.8%. But again, well within the recent range that we've seen, really going back to the beginning of 2022. At the cap of 4%. So ostensibly not a controversial set of figures. Now, again, with what we're seeing with U.S. economic data, there is some risk of upside. We could see something bigger. And again, wind back some of these rate cut expectations. And then, of course, the key becomes, do stocks still feel good about it? If they do, probably have quite a bit of risk on follow through because the relationship has meaningfully changed in equity holders' favor. But if we get into questioning whether there will be even 5 and perhaps 4 rate cuts, perhaps 3, what will the Fed's tone be? Will they push back harder or less aggressively? And what will the data say? If that gets us to, let's say, a meaningful further adjustment away from dovish extremes on Fed policy odds, well, a risk-off bout might play out across the spectrum of markets. But one thing that seems pretty clear, at least from the way things have behaved so far, is that the U.S. dollar probably is well supported. And in an environment where, at least in the case of the Eurozone, the direction of travel seems to be in the opposite direction, we could very well see some action in currencies, if not necessarily in stocks, though the decision time there certainly beckons. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the performance on Wall Street at the close of the day and what that means going forward. I'm also on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Should be a big week ahead. We'll cover all of it here on Macro Money. See you tomorrow.